Well, good afternoon, everyone, and following on from our success of our first webinar a couple of weeks ago, you're very welcome to SIOR's European second webinar in our series of interesting and hopefully relevant topics of interest to our members and their guests. Our speaker today is Matt Richardson, who will address us on knowing me, knowing you, how well do we really know our occupiers' covenant strength? So an interesting topic. Just to introduce myself, I'm Paul McDowell, the current president of the European Regional Chapter of SIOR, sitting here in, I'm glad to say, sunny Dublin. Our chapter members have joined us from countries from across Europe and Africa, including Belgium, Croatia, Poland, Holland, Nigeria, France, Ireland, Italy, and of course the UK. We also have pleasure in welcoming some of our US and Canadian colleagues, particularly the SIOR Global President, Mark Duclos, and past President, Stan Mullen. You're all very, very welcome. We're also very pleased to have members from CREW Network, that's the Corporate Real Estate for Women, with whom SIOR collaborate to promote women within our industry. Our leadership have a clear intentional growth, international growth strategy for SIOR. So if you're not yet a member and would like to join, please contact us on sioreurope.com. If you have a relationship with a real estate student who's studying, or a real estate educational course or university, we're currently running a competition for one student to win an all expenses paid trip to Boston, Massachusetts in October as part of the SIOR Foundation Student Real Estate Experience Program. So please contact for more details. It's a fantastic opportunity for a real estate student to participate. A bit of housekeeping now. Your mics and videos are turned off. However, please feel free to ask questions through the Q&A function, and we'll respond at the end of this presentation once Matt is finished. Now I'd like to introduce you all to our moderator for today's webinar. That's Simon Stretch. Simon is, hi Simon. Simon is SIOR's European PR consultant and runs our social media campaigns. Please do follow us if you're not doing so already. Last, but of course certainly not least, I would like to introduce our speaker, Matt Richardson. Matt is a co-founder and CEO of Income Analytics Ltd. He has more than 30 years experience of working in European, US, and Asian property markets. Prior to setting up Income Analytics, he was the Director of Research European Real Estate at Fidelity International in London. Matt is visiting lecturer at Oxford Brookes University in the UK and has also lectured at the London Business School, Maastricht University, London School of Economics, UCL, and Cambridge University in recent years. Having already seen Matt give this presentation before, I assure you that the next 30 minutes or so is going to change your perspective when assessing a commercial real estate investment, particularly in these times of change. Matt, over to you.
Okay, hopefully I've got the right slide showing there. Good morning, afternoon to everybody. I'm hoping you've got as nice weather as I have, but I am slightly cooking up here in my loft, so do forgive me if I look like I'm sweating a little bit. First of all, thank you for inviting me to come and speak to you all. It's a very interesting time in the commercial real estate market. Even leaving aside what's happened in the last few months with COVID, we were already beginning to see a market where capital growth dynamics were running out or had been slowing as QE was eased, and we were seeing a greater shift towards income-driven investment. So what I'm going to talk about today is I suppose the fixed income or debt piece of real estate versus the sort of more traditional equity approach to real estate, and I'll explain what I mean by that in just a moment. In a sense, when we're talking about commercial real estate, and I make that term very decidedly, I'm not talking about owner-occupier residential here. We're talking about institutional investment markets, really, and institutional real estate, which may include residential letting, but primarily we're talking about retail, office, industrial, and alternatives for the purposes of today. Commercial real estate, in the end, is a commodity. It's space. and we're buying and selling space to perform functions, economic functions in that space. And as Professor Andrew Baum at SIOR Business School put it so succinctly, the value of your real estate investment is ultimately determined by the quality of the rental income paid by your tenants and the duration of that income. And real estate is ultimately about somebody paying rent today or in the future in the case of a development. And I think often that gets lost, and my heart sinks when I often open the newspapers to see headlines such as "property prices ... because, as we'll see in a moment, more important perhaps in all of this is the income derived from property and how investors use that. So for the purposes of today, what are we going to cover in this session? We're going to look at real estate, commercial real estate as an investment asset class, and just look at a few basic drivers there that may surprise a few people, may not surprise all of you. Some of you may well be ahead of me on this and doing what you're doing. We're going to look at how people approach looking at counterparty risk, and by that I mean tenant quality in buildings and potential future approaches and new ways of looking at things. We're also going to look a little bit at the primary data sources in this area, that being the company credit reports. And we're going to look a little bit at how we interpret those, what data's in them, how we can extract that data, and then go on to look at how we can potentially deploy that data at tenant, asset, fund, portfolio level, etc. And finally wrap up with a little bit around why this is becoming such an important area within commercial real estate markets, and really why, as an industry, we need to get our house in order a little bit, because there are a number of things colliding to create something of a perfect storm in our sector in terms of why we need to address this particular issue.
Matt, before you carry on, sorry to interrupt you, could you share your screen just with one slide at a time?
Sorry, what's I can't see what
we're seeing it from the whole of PowerPoint point of view rather than the slideshow point of view.
Is that? Yeah, sorry, that was what I was asking right at the beginning.
Perfect.
Is that better now?
Perfect.
Okay.
Thank you.
Okay.
Sorry to interrupt.
That's all right. Okay, let's start with thinking about real estate as an asset class, because commercial real estate is a hybrid asset class. It performs a number of roles in investment portfolios. So on the left of the chart here, we can invest in it as equity. So essentially, what do we mean by that? Well, the return is predominantly coming from capital growth. We're looking for a price lift. We're typically not as focused on the dividend yield, the tenant income per se. And I suppose the nearest match to in property world would be actively managed assets, etc., where we're looking to do perhaps a shorter turnaround and capital growth. On the right-hand side, we can also use commercial real estate to perform as a commodity, fundamentally. So land or development assets do not necessarily have any income attached to them, and we're simply speculating on going from potentially greenfield site to a built environment and creating an intrinsic value from doing that. And then, for the purposes of today, probably the area we're going to be most fixed on is the fixed income component of property. This is buying commercial property with a view to taking the predominant piece of your return from the income. So you're using this effectively to mimic some of the features that you would expect more perhaps in the bond market. And this is the sort of long lease approach, but actually it's a far more generic approach than perhaps many people realize. And I'll come on in the next slide to explain why that is. So we can see that property does lots of different things, and we can make it do lots of different things in multi-asset portfolios or just within property itself. But the key thing that we have to remember about commercial property, it is not a homogeneous asset class. And what do I mean by that? I mean, there is no such thing really as a property market. Property markets exist at point of transaction between the buyer and the seller, because no two assets are the same. So while we can look at averages and while we can look at individual transactions and group them up, in the end, buying an office in Boston does not give me the Boston office market return. It gives me the return on an office in Boston, which mathematically is a very, very different thing. Okay, we're going to loop back to that theme a little bit in a moment. And finally, the characteristics of real estate and the sources of return differ from around the world. So what I'm apologies, for some reason my okay, so on slide here, slide 4 here, what we're looking at is sources of risk and return, okay? And if we understand this, you'll understand where we're going in the next bit. What this chart shows us, using data supplied by Fidelity and by MSCI, the Global Real Estate Benchmarking Service, is the long-term total return since 1985 from different markets around the world. And that total return is split up into its income and capital components. Now, there are some really weird outliers on here in Germany and Japan on the left, and this is to do with very market-specific issues where virtually all their return has come from income return, but they suffered a lot of asset deflation, which has somewhat deflated the numbers. But looking at the rest of the cut there, what you see immediately is in Western Europe, North America, Australasia, a very clear differential in that the bulk of the return in those markets is coming from the dark blue, from the income, as opposed to the capital growth drivers. And if you go across to the right and you look at more emerging markets, you begin to see that that reverses, and those markets do behave more like equity, with the primary piece coming from capital growth. And on reflection, that makes a lot of sense because, of course, often in emerging markets, you're going from greenfield to fully built environment, whereas in more developed markets, you're often having to acquire expensive real estate before you redevelop or reposition it and let it. So in a sense, we see emerging markets behaving more like equity versus long-term developed markets tending to behave, or property markets there, tending to behave more in line with their income characteristics. And if we dig a little bit deeper into that and look at the UK market, which is probably the most deeply researched market by MSCI, the chart on the left here shows you the individual investment market returns from MSCI year on year from 1981 through to 2018, and it breaks up those returns again by income, the dark piece, and then the orange piece is the price movement. And what you immediately see here is the volatility attached to capital growth movements. And the first thing that you need to take away from that chart is calling price movements in property is a highly dangerous game, whereas banking on stable income is actually quite a safe bet. And that's borne out by the charts on the right of this screen. And what these two charts show us, the top one shows us the long-term income component versus the capital component in the UK market. So roughly around 70% of your total return per annum, and this number is, if you run these stats in the US, Canada, the Netherlands, Sweden, Australia, you'll get exactly the same set of results. 70% is coming out of your income, and about 30% comes from your capital growth. So again, this predominance that actually it's always been about income for commercial real estate investors. And then let's go down to the bottom and look at the volatility attached to these two income and capital components. Income is delivered with a plus or minus 1% variance every year. This is highly stable return, whereas capital movements are around plus or minus 8% per annum, meaning they're highly volatile, which means as investors, really, we should, as an industry already, leaving aside COVID, we should already be spending way more time looking at the income component because it's more stable, it's the bulk of our return, but more importantly, it's the piece we can control because it's linked to the leases and the quality of the tenants. Calling markets, chasing markets in property is a highly, highly difficult business. So what are the implications for us? The implications at the moment for where we are in the cycle is that in the absence of capital growth, it's difficult to see much more yield compression in most of the major markets. Indeed, in some of the sectors like retail, we're seeing yields unwind quite rapidly. Real estate becomes a fixed income style investment. Let's just think about that. What do we mean? What we're focused on is the lease, because the lease effectively is a term agreement to pay money for the use of the space. A bond is a term agreement to use money in return for the capital. This is behaving more like a bond, and we need to analyze it in that way as well. So from a real estate perspective, what we really need to focus on at this point is the individual occupier, the business environment that they're operating in, and specific requirements that they might have. So we have to get a lot of information about that counterparty, because that's where our return and that's where our risk is going to be coming from. So if you're adopting an income-driven approach to investment, there's some very simple objectives we have to sort of think about. As with any investment, what we're trying to do is minimize risk and maximize return. That's the very nature of investing. But there's three things here that I've highlighted as we start looking at specifics. The first is, it's all very well looking at a credit rating on a tenant, but of course you're taking an obligation often for 3, 5, 7 or 10 years to that particular entity. So how comfortable are you that they can support the current cash and future commitments based on their credit quality and the structure of their business? You know, one time long ago, Kodak was an undoubted covenant. Now it doesn't exist. Secondly, we need as an industry to move away from subjective labels, and something that drives me mad in our industry is the use of core and core plus and value add and very loose terms to define risk. In other sectors, risk is defined using empirical evidence and data. And this is very important. If I'm buying a bond has a rating. The rating relates to a yield, and the yield relates to a price. So I understand the risk of what I'm buying. In property, we don't have that, and we tend to use things like undoubted covenant when the appraisers and valuers are looking at things. And we really can't carry on like that. We need information to understand the specific risk we are taking at that point in time and put that in cash terms. And then the final piece is, so much of the underwriting and due diligence work is focused on the equity piece, the physical building, the valuation, etc., which is fine, it has to be. But really what we do need to do as an industry is bring the equal weighting of the income piece up alongside that. So the two pieces fit together and reflect that hybrid nature of property that it is in. Sometimes a fixed income vehicle, and at other times it's an equity opportunity for investors. So we need to be thinking about how can we get numbers, how can we deploy them into our decision making and monitoring processes. I'm going to move on now and talk a little bit about how we source credit data in our sector. Now, the primary source for most of us are what we call the credit reference agencies, the CRAs, and it's very important that we understand the difference between these guys and the credit rating agencies, okay? The rating agencies, S&P's, Moody's, Fitch, and others, are focused very much on a small end of the market, the commercial paper, the bond market, where you have a highly regulated issuance of debt. And they use far more sophisticated techniques, but come with a very, very sophisticated price, and their coverage obviously is relatively small compared to the universe. So to give you an idea, companies like Equifax, Dun & Bradstreet, CreditSafe, Experian typically cover between 330 and 350 million companies around the world with their credit systems. And their credit systems effectively are looking at historic data and giving you some views towards the future, but they're really looking at credit rating, and they're not specifically designed for real estate people, although we all use them. And last year it was estimated that between us all around the globe, we spent about 250 million US dollars buying credit reports from the agencies. But what did we take out of those reports, and how did we use it? So lots of great information in credit reports from the rating reference agencies, but they do come in PDFs, and we then have to play around with the numbers. But from a real estate specific perspective, there's a couple of things that we really do need. We need a long-term forecast of tenant default, which we don't often get, or we can't get from a traditional credit report. There is no standardized international scoring system at present, which drives, for those of you who work in this space, will drive us all nuts. And it's very, very difficult to group the data and play around with it, etc., and analyze it. And that's really why again, as an industry, we need to start working with the reference agencies on what our requirements are and how we need to tweak, because most of these systems were developed not for us, but for manufacturing and retail suppliers to look at cash positions. But the principles are exactly the same. So let's have a think about how we interpret a credit report. Now, what's very interesting is when I speak to most people, they take the credit rating and they look at the balance sheet, which kind of makes sense intuitively when they look at a credit report. But let's think about that. The credit rating is a point-in-time analysis about where the company's cash position is as it moves along. Okay, it's for a major company, it's always going to be in flux and changing because of announcements, profits, etc. Always impacting and changing these things. And the balance sheet, of course, is a backward-looking measure. I would suggest that what we should as an industry be paying more attention to is a side number that all of these guys create called the failure score. Because as a function of their scorecards, when they start to put together credit ratings, part of it is based on the model of how often do companies go bust or cease to trade. And those failure scores are very interesting indeed, because for the real estate industry, rental income is a binary thing. We have it or we don't. And we should be making our investment decisions along those lines and applying it to actual percentages. And if we focus on the failure score rather than the credit rating, we can now begin to look at how often do companies with certain types of industries, in certain types of credit profiles and certain types of business models, how often do they go bust and stop paying? That's a far more important figure for me. And the second thing that we need to be understanding is identification, not just for KYC and for all the right things with compliance, but increasingly we are a globalized business. Commercial real estate investment is a very complex globalized business. We can see Middle Eastern money coming through New York to London to go into Germany, etc. What we need to understand on the counterparty side is where does the risk lie? Because often our tenant in Germany may be a subsidiary of a Swiss company who's owned by a private equity company out of Boston. So understanding identification of companies and not treating them in isolation is tremendously important. And the credit reference agencies are very good at that. That's something you should look for in those reports. Now, obviously, the balance sheet and the credit rating are interesting measures, but I do think we need to spend way more time on those two features of the reports from the credit reference agencies, because they give us empirical data we can apply to cash flows. So how does a company credit report work? They're pretty complex models that these guys use, and they take in huge amounts of data, which is why I would urge none of you to try and do this at home. The range of things that a typical model looks at, I've tried to highlight on that top line there. So I've put 6 boxes in. We're looking at filed accounts of companies. We're looking at, is it part of a parent or larger group? We're looking at financial trend analysis, both for that sector and for that individual company. There will be an input, particularly for retail, on commercial and consumer data that's feeding that model. And as we get towards the smaller end of things, we begin to get information like credit card positions on directors of companies and payment performance of utilities and rents. And for smaller companies, those things become very, very important, because they're some of the few indicators we have of distress with smaller companies. With the larger companies, conversely, the filed accounts, we tend to have quarterly reporting, we tend to have regulatory news announcements in major markets, and we have the stock market giving us some guidance on what the underlying corporate health of companies is. And the parent and group information is also very important. Now, in some cases, some of you may have a guarantor in place to, if you're slightly worried about a tenant, you'll get the parent to guarantee it. And that works very well in some instances, but as we know with retailers, big retail groups at the moment, we're seeing a lot of large companies walk away from commitments and deliberately structure companies so that they can be removed from the stack and they can effectively walk away from that cash commitment. it's a very interesting area, and I'm happy to take questions on it later. But you see a very big difference in that area in terms of types of companies that will do that, because obviously defaulting on or walking away, even if it's legal to do so, has huge reputational risks for certain people. But what you're looking at there is a very large universe of thousands of bits of data. And as I said, these guys are covering hundreds of millions of companies around the world. So you can imagine the data churn to do this. And then from a real estate perspective, the key outputs in orange in the middle there that we tend to focus on are the credit rating, because that gives us a point in time. And then the two areas that I majored on just before, the failure score, the probability of failure. This is a predictive model based on all those things in the inputs. How often do companies with a specific profile go bust? And there's a mathematical number that comes out which says in year one, a company with a score of X goes bust X% of the time. It gives us a percentage probability. And the final thing that the credit reference agencies can provide is with a cash and credit limits, because they're looking at payment patterns going in and out of companies. So do look at those when you're looking at credit reports. They're some of your best short-term indicators, particularly for small companies. And then if we were going to drill down to the blue bit, target data, the sort of gold for us in the real estate industry, I would say you want to be focusing on the probabilities spilling out from those failure scores. Those failure scores will all relate to a percentage probability of failure over a time period in the future, which you can apply to cash flows, okay? Ditto credit limits. Credit limits are a very good way of checking the affordability of the rental commitment versus their ability to pay. It's not baked in, but it's a very good measure. So use some of the recommended credit limits, map them to your rents, and see how safely inside you are. They're not always right, but they're a great way of highlighting potential problems that you can then go back and discuss with either the credit rating agency or with the tenant themselves. And in some instances, you may even decide that you want to talk to the tenant about moving the lease to another part of their company that has perhaps a stronger balance sheet or a different risk profile. So what we then can do, and this is one for the maths geeks, if we have that 12-month probability of business failure, which all of the reports kick out, and go and look for it, you'll find it in there, you can begin to do some very interesting things with your calculating your default probabilities, okay? Because the first thing you can do is go back in and look at deeper data with the agencies and say, okay, what were the outcomes beyond 12 months? So 10 years ago, how often did companies that had a score of, I don't know, a default of 1%, how often did they go bust in year 3, year 5, year 10? And that data exists on the credit scorecards for all of these companies. And it allows you to build essentially a forward default curve in the same way that S&Ps or Moody's or Fitch do for bonds, because it's based on the reality of how many companies went bust against that scorecard. Now, it doesn't vindicate the scorecard as perfect, but what it does tell you is, based on all the data available to them, how often did a company go bust? And that is a very good measure, because you can relate that to your individual tenants, okay? What we can do is look at that data, and we can map it on to our 12-month probability and begin to forecast out how likely we are to be looking at a loss, depending on the lease term of whether, as I said, it's 3, 5, or 10 years, etc. Okay. And the third thing that it allows us to do, by using a percentage rather than a rating or a score, we can now compare the probability of loss cross-border and internationally. And this is very important where we're dealing with international global stacks and complex counterparty risk. So we're just going to have a look at a couple of applications for, if you adopt this approach, what you could do. So I've used an example here in Europe of DHL. So DHL is a subdivision, as you know, of Deutsche Post. It's the logistics arm of it. It's a very large company. So let's think about what we did with the scores and ratings here. We got a probability of default from the failure score, from the credit report, and we forecasted it out. we looked back at the data and we said, okay, let's look at, based on a company with this risk profile today at 0.13%, its 10-year defaults in historically have been around 1% of the time these companies will fail. This is very secure income effectively. And we can imagine that, whoops, sorry, let me go back. For some reason it's not letting me go back up to, okay, sorry, we're back. So on the top left here, what we're looking at is the probability of failure projected. So this is that effectively looking at the outcome. So DHL here, with a credit score of this today, we can project out 10 years what the forward curve would look like. This is just an outcome-based mathematical model, which is a lot of data, but you could do it yourselves. We can also look at the history of DHL and how it's performed. And then what we can do is take that percentage measure and that curve, and we can map that across the corporate bond world if that's what we want to do. And someone with a risk curve that shape is actually a BBB equivalent bond rating based on the S&P Moody's as at today. So if you do want to talk to your fixed income guys or your debt guys in a language that they understand, you can now begin to convert some of that tenant data into synthetic ratings. And again, I'll take questions on some of the difficulties around that. But what I'm trying to show you here is what you can do with the data if you extract it and focus on the right things from the credit referencing agencies. All things are possible, okay? And suddenly we're able to sit at top table with the equity and debt guys and talk in a language that we all understand, and our ratings and our risk are based on empirical evidence, not on subjective labels. If you particularly like data, we can take those four things, tenants, and if you want to, and you really like this kind of thing, you can roll it up, weight it by the rent, and you can create asset stream tranches. You can tranche the income on your property effectively and put it into a stack and say, as at last night, my property had income streams tranched in the following way. And we're finding that banks are increasingly looking at this model because, of course, it gives them insight against the individual asset to the structural risks and allows them to more accurately price the margin that they will give you on the debt, because they understand finally in a language that they have what risk it is they're taking on as at that point in time, and then obviously they can monitor that as they go along. But again, all of this is just coming out of those 2 or 3 basic numbers if you look at them. So each of these effectively that you're looking at is one of the leases in a building mapped back to a credit rating and put in a stack. So again, now I'm talking in a way that I can understand and compare with other assets or with my compliance officer, whoever else I'm dealing with. And finally, if you want to, what you can do is roll up your assets and start looking at your fund. How is my fund structured? How are the individual grossed up tranches? So again, I want to go speak to the bank. I want to talk to an investor. In a matter of seconds, the investor can understand the quality of the income. You've got a live mark to market on your income, and you're understanding what it is, and you've got some numbers against what you're doing and how you're rating that counterparty risk and putting it in the context of broader investment markets. So why is this kind of approach so important, and why do we need to start thinking about the analysis? Well, all markets at the moment are under huge pressure for greater transparency from the regulators, from our own internal compliance, but most of all from investors, because quite often our investors may be very far away, they may be in different time zones, and they need the ability to access the base data. But there are other points driving something of a perfect storm in our sector right now. I would start on the one in from the left. We are seeing a huge amount of capital spill into our sector from the bond market. There are the QE, and more recently with all the COVID fallout, where we're now seeing interest rates going back to zero and negative interest rates across the board, it's very difficult for investors to get a significant yield in the bond market, certainly at the government end of it or at the AAA end. So they're increasingly coming into property and using property as a proxy for bonds. And that's why we're seeing quite so much money come over above and beyond a lot of the traditional investors. We're also seeing this globalization, financialization of the sector. And as we become part of the global infrastructure of investment markets, we need our data to be in a format that people can understand and can compare and contrast. And this is very, very important as we move into the world of passive investment, because the algorithms that allocate in the passive investment world to the passive funds do so based on data. And if the real estate sector doesn't get its act together in this area, we risk missing out on being able to tap that whole new subsector of the market. It also allows us to do like-for-like multi-asset investment strategies where we can combine equity, debt, and commercial property into a single vehicle for investors. And again, for those of you who are working in the institutional investment market, you'll know what a big growth area that has been. And then just generally, it's best practice and improved analytics. You know, why should it take 3 weeks to figure out who's in my portfolio and what their risks are? A counterparty risk is. It's the sort of information that should be at our fingertips as we work. And then finally, who should be using this kind of analysis? Well, really, we all should. Whether you're in the real estate professional side and you're broking, to give the potential investor a clear indication of the risks and duration risk, surely that has to form part of the disclosure process, whether that's in the brochure or at least in the data room. And we also think that valuers, appraisers should be looking at this. They are doing a cracking job on the equity piece, but they need a lot more data to understand the income side when they calculate those yields or cap rates. And on the right-hand side, the lenders, obviously, it's a big area for the lenders. They are far more regulated than the investors. It's a great way for them to understand what you're offering them in a way that they understand it. And then for most of the people I'm assuming on this call are probably going to be in the investor space in the middle or professionals. It really is just good management and a great way of running your due diligence and management process. If you hold assets, you should really be monitoring not only just the risk, but the risk by the subsectors, the risk by the company type, and globally, how much exposure do you have to a particular group around the world, etc. So conclusions, really. Real estate, commercial real estate, certainly in the Western world has for a very long time been about income anyway. We just tend to forget that when we have our periods of irrational exuberance. And they usually end with the debt markets not really understanding property and property not really understanding debt markets. And I've been through several of these and had hair when I first started with all this. And it usually ends the same way with most economic downturns. When the scrimmages are unpicked, at the bottom with the ball is real estate. And the reason for that is I think people get too fixated on the capital side. So we should always be looking at the income side anyway. It's the piece of the equation we can control. And to do that, we must understand the occupiers, who they are and what they're trying to achieve. But more importantly, turn their balance sheet and the credit data about them into something we can use to price cash flows, okay? And we need numbers, not labels, please. If there's one message we take away from today, numbers, not labels. We want to think about long-term probabilities of failure. We want to be able to link what we're doing in our world with other worlds and investment asset classes and express that risk in cash terms, okay? So I just think that this is part of that process as real estate converges with equity, fixed income and other markets. So thank you very much. I hope that's got through everything on this, but thanks for your time on this very hot day.
Thank you, Matt. That was a very enlightening talk and gives us plenty to ponder, I think. So just a reminder again that the Q&A channel on the bottom of your screen is now open and we'd be happy to have questions submitted through that forum. And before we get stuck into that, I just want to run a couple of very quick polls, just assessing our audience's views on risk and where they think the market sits right now. So bear with me just a few seconds, and we'll see the first question about how and if COVID has affected understanding of tenant viability.
So Matthew, would you like me to stop sharing, or?
No, that's fine.
Okay.
You can put your bio contact details on, that's fine.
So it looks like you're not quite out of a job yet, Matt, judging by the responses on the current poll.
I would prefer to be out of my attic, though. It's very hot in here.
And we'll give this just a few more seconds.
All right.
And we shall run just one more. Sorry, change. And it seems, yes, current uncertainty inevitably has changed people's understanding of tenants' viability longer term. So let's close this for now, and we can get into some of the Q&As. So first question is about the corporate debt market. So what do you think about looking to the corporate debt market as a proxy for covenant? Albeit hindsight's 2020, but thinking of investors who bought office buildings in the City of London, perhaps let to WeWork at sort of sub 4%. At the time, WeWork's corporate paper was at 7 or 8%. Do these investments represent asymmetrical risk to the downside from the outset?
Sorry, let's look at it in bits. I think the corporate debt market is a very good indicator. The problem with the corporate debt market as it interacts with commercial real estate is that the bulk of the tenants are not rated entities. So it's very limited as to what coverage you can get. It's certainly very good if you own a massive office building and you've got Morgan Stanley in there, then the numbers are going to be pretty good. And I would hazard a guess that you're better off using, because the credit rating agencies will have far deeper insight into those companies. As I said, the issue is there's not actually, in the universe of 330 million companies, say, covered by Experian or Duns, it's a fraction that will have a publicly listed bond rating. But where it's there, definitely use it. It's good information, and those guys do a great job at what they do by and large. Particularly when you look at the histories. Moving on to WeWork, I'm not going to say too much here. Anyone who knows me knows what my views of fixing costs long and taking income short are. I remember Northern Rock and many other things down the years. Yes, bonds in the end, or any term agreement, a bond release, still comes back to this issue of how good is the counterparty, whether it was the CMBS tranches of of 2007 when nobody looked in the box, they just looked at the bond rating. I feel there's a little bit of that being going on with all of the, shall we say, flexible leasing models, where it's big, therefore it has a bond rating, ergo it must be a good counterparty risk. I think you've got to be very careful making, big is beautiful statements. Again, it comes back to the numbers. The first thing anyone should have been looking at with WeWork or Flex or any of these guys, and some of them have got great models and they will survive and they'll do well, but you are still looking at an income stream where the liabilities are long and the incomes are short. Now, that is not a great model in highly volatile financial markets and has been proven to be time and time again. And one of the things that has me reaching for a parachute in every cycle is the phrase I hear from people, this time it's different, because invariably it isn't. So be very careful with looking at the models, and certainly don't slavishly follow the corporate debt stuff. It's very good, but really what you should be using these things for is to prompt conversations. And in the end, I would hazard a guess that for most of you on this call, you don't need anyone to tell you that the Shell Corporation, Siemens or Amazon are a great covenant. What you really need to be focused on is that tail risk of 15 or 20% at the end, who do go bust through cycles, the smaller guys who have a wide range of models. And they're the people that you really need to be locking in and focusing on as much as anything, because if they go, that's the difference between you delivering on your investment return and not.
Thank you. And you focused a lot on income during your talk. And what do you think that means in a market with shorter leases? What's likely to be the biggest risk for an investor? Is it likely to be tenant default, or is it more of a risk that the tenant won't sign a new lease when it expires?
Well, it's been an interesting one because leases have been coming in for decades now. I mean, when I first started out in the late 80s, we used to have things called 25-year upward onlys in the UK. You don't see too many of them anymore. The typical lease now in Europe, for instance, is down around 7 years. Now, this isn't necessarily a bad thing, because the lease negotiation is a game of give and take. So while we lose, shall we say, the long-term sustainability of a 10-year or 15-year lease, the tenant, by and large, is willing to accept that there will be a rental premium for the shorter lease. This puts a lot of emphasis back onto the investor and the lender, because effectively you do have to deploy cuter underwriting skills, and you also have to understand who would take that space if the tenant's not there. So this becomes down to your understanding of the building as well as the individual tenants. So there is a trade-off, and I suspect, and it's been shown in this, as the bond market yields have collapsed generally. Okay, it's not happened at the speculative end of corporates, but by and large, the reason a lot of people have come into property is that you are getting this additional yield on the investment, and part of that is liquidity, and part of it's the fact that leases are shortening. So it's not necessarily a bad thing. I think everyone just looks at it and goes, oh my God, short lease must be terrible. Actually, if you're a good active manager and you're in a rising market, short leases actually work in your favor very, very well.
Okay, thanks. And moving on a little, do you have a view on REITs? Given, I guess, they're mostly trading at a discount to NAV at the moment, do you think tenant covenant is reflected sufficiently in this discount?
The REITs are slightly different, because obviously they're covered by the equity analysts, who by and large in my experience are quite detailed in how they go into things. So to answer the last bit first, I think they're quite well covered in the level of analytics that's undertaken. I still don't think personally that there's enough counterparty risk hard numbers in there baked into the yields. But more generally within the REIT sector, of course, what we're seeing is a sort of asymmetrical reaction to what's happened in the property market, particularly pre and post-COVID, in the sense that while we have seen some huge discount to NAVs, particularly in UK Dutch retailers, we're actually seeing some very, very tight numbers on the logistics side. So what we're seeing is the REIT market effectively shearing based on the business models and the land use for those. And that comes back to business models fundamentally. People are happy with distribution models. I mean, one could argue that logistics actually is retail, but just retail from a big shed with a PC instead of a shop window. But fundamentally, it's about the business models again, and you're back to the tenants and doing your due diligence on the structures. So if we were just to quickly look at that, the areas that are suffering are the one-to-many outlets. So this is high street retailers where you store the stock on, people come in and buy it. That's what's being killed or being killed by the internet. If you think about the models for distribution from warehouses, you will have the retailer doing the distribution and the sales piece there, but often in the background, the underlying lease is to a logistics company, which is usually quite a long lease, and they will be in a fulfillment contract. So it's a very different risk structure, but it comes back to business model again, and that should be baked into the pricing.
And going back to your points at the top of the presentation about failure scores, how does that, one issue we're seeing now is the prevalence of sort of can pay, won't pay tenants. So whilst the failure score might predict a tenant's likelihood of going bust, what about those who are in actually fairly good financial health but simply aren't writing the check every quarter day? Is that just, are we likely to see that just as a COVID related problem, or do you think it could seep in more generally, and what can we do to mitigate it?
Wow, could spend the afternoon on this one, couldn't we? It's not a clever thing for a lot of them to do, because ultimately it affects your credit rating, which pushes your cost of borrowing up in the long run. Having said that, it's a function of the market at the moment. So what I would say to everyone on the call is, there are two bits to this, if you remember, that we were looking at. The failure score is the outcome of how often companies go bust. What you should also be looking at from your credit referencing agencies are something on there which are the payment and delinquency scores. And these, all the credit guys pool data on how often utilities bills are paid, rent is paid, suppliers are paid, etc. And you will see scores on there which are quite short term. They're sensitized down to about 3 to 4 weeks as payment patterns come in. And they're usually quite good indicators of company going into distress short term. When you see those lengthening out, you usually know that there's problems coming. You do have to be careful reading those, because what you also find is that big companies bully suppliers, so they pay late and just say, yeah, whatever. And you know, you're a small supplier, what are you going to do? So I would focus on those delinquencies, look at them, talk to the people you're buying the data off, so you understand what those numbers are telling you, because otherwise some of the failure scores can be a little bit too backward looking. As it regards to COVID, I do think it is a COVID prompt, but I suspect there's a wider conversation to be had between landlords and tenants at the moment. And one of the big problems with tracking the credit ratings of tenants right now, as you said, is sometimes just a policy of, well, no one else is paying, I'm not going to pay. And we're not necessarily seeing the deterioration in the credit ratings yet. One, because the numbers haven't come through. We're still waiting for the sales figures and the other things to come through. They usually take a month to 3 months to 6 months to filter through. And the other thing that is very difficult at the moment for everybody, and I appreciate for everyone on the call, is that the credit ratings are quantitative, so they do rely on numbers. And what we don't know is how much money individual companies are taking through the furlough schemes and taking through effectively QE measures from central government to shore up their balance sheets. That won't become evident till probably third quarter this year. And then we'll see, as the old saying says, who's wearing swimming trunks when the tide goes out.
Indeed. Okay, well, I think in the absence of any further questions and mindful of the time, it's probably time for me to hand back to Paul. And thanks again for your time, Matt, and thanks for answering.
Thanks very much, Simon, for doing that moderation, and thanks to you, Matt, for a fascinating insight into how to really assess the real quality of your tenant as a long-term income stream. As I said earlier, I'm sitting here in Dublin, venue of the 3rd SIOR International European Conference. You'll know by now that this event has been postponed to July 2021 from July this year, and we look forward to hosting a great event there. Without the support of our members and our sponsors, this conference would have just been cancelled. So particular thanks to our platinum sponsor, Bank of Ireland, our gold sponsor, TSL, as well as Axie Immo, Carter Jonas, Colliers, Corfac International, Society of Chartered Surveyors Ireland, Finnegan Menton, FKM, Murphy Hall, to name but a few. Also, our thoughts and prayers and condolences go out to all those who've been affected by this pandemic as we look forward to the world slowly beginning to open up again. To quote our late great poet, Seamus Heaney, which I think is very apt in today's world, believe that further shore is reachable from here. Believe in miracle and cures and healing wells. Thank you for joining us today from SIOR Europe's webinar, which will be made shortly available online. Join us again, please, for the next month. Details will be announced in due course, and in the meantime, have a great day and goodbye.